Let me guess. You've been doing your homework. You research before you buy. You don't panic when the market dips. You think about the long term. Honestly, that already puts you ahead of most people. But here's an uncomfortable question worth sitting with for a moment. What if some of the habits you think are making you a smarter investor are actually quietly costing you money? Not because you're doing anything obviously wrong, but because you're optimizing for the wrong thing entirely. Today, we're going to look at a real study run over nearly 2 decades of actual market data that might flip some of your assumptions upside down. And the results? They're a little humbling for all of us. Welcome to Slowfolio, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Everything you hear here is purely for education, not a recommendation to buy, sell, or do anything specific with your money. Alright, so let's set the stage. The question at the heart of today's video is one that almost every investor eventually wrestles with. Does it actually matter when you invest, or does it only matter that you invest? Think of it like planting a tree. You've got a seed, a patch of soil, and a watering can. Now, you could spend a lot of time standing over that patch, waiting for the perfect moment, the right temperature, the right humidity, the right angle of sunlight. Or you could just plant the seed today, water it regularly, and let time do most of the heavy lifting. Most people, when they're new to gardening, obsess over the conditions. Most experienced gardeners know the real variable is just, did you plant it, and did you stick around long enough to see it grow? Investing works surprisingly similarly, and Charles Schwab published a study that put this idea to a rigorous test, tracking 5 different investor behaviors over a 20-year period from 2003 to 2022, using actual S&P 500 data. The results were, to put it mildly, not what most people expect. Now let's talk about who was in this study and what each person actually did. Schwab laid out 5 fictional investor profiles, each given $2,000 to invest every year for 20 years. That's $40,000 in total contributions over the full period. The only difference between them was their behavior, specifically how and when they chose to put that money to work. The first investor, let's call him Perfect Pete, had superhuman ability. He invested his $2,000 at the single lowest point of the market every single year. Every year, without fail, he caught the absolute bottom. If you've ever tried to time the market, you already know this is basically impossible in real life. But the study gave Pete this superpower anyway, as a kind of best-case scenario benchmark. The second investor, let's call her Ashley Action, didn't try to time anything. On the very first day of each year, she invested her $2,000 immediately. No questions asked, no waiting, no strategizing. Just in, right away, every January. The third investor, Matthew Monthly, split his $2,000 into 12 equal chunks and invested a little bit each month. A classic dollar-cost averaging approach. Steady, consistent, automatic. The fourth investor, Rosie Rotten, was the mirror image of Perfect Pete. She invested at the worst possible moment every single year, catching the absolute peak before every dip. The unluckiest investor imaginable. And the fifth, Larry Linger, never invested at all. He kept his $2,000 in cash each year, waiting for the right moment that never quite came. So, perfect timing, immediate action, monthly averaging, worse timing, and no action at all. 5 approaches, same contributions, 20 years. What happened? Now let's be honest about what this data is actually telling us, and what it isn't. It's not saying timing doesn't matter at all. Perfect Pete did win. If you could somehow always buy at the lowest point of every year, you would come out ahead. But that's not a real strategy. That's a fantasy. The study's actual point is about the cost of waiting versus the cost of imperfect action. Think of it this way. Imagine you're deciding whether to start running for fitness. You could wait until you have the perfect running shoes, the perfect route, the perfect playlist, the perfect weather. Or you could lace up whatever shoes you have and go outside today. The person who starts today in okay shoes will, after 6 months, almost certainly be in better shape than the person still researching the perfect gear. The conditions don't have to be perfect. The consistency is what compounds. What the Schwab study really confirms is that the gap between perfect timing and immediate imperfect action is surprisingly narrow, and the gap between any consistent investing and waiting forever is enormous. That's the real headline buried inside the numbers. There's also one more thing worth noting. This study covers the S&P 500 across 2003 to 2022, a period that included 2 major market crashes, the 2008 financial crisis and the COVID-19 sell-off in 2020. Even across those crashes, even for Rosie with her catastrophic timing, being in the market consistently produced dramatically better outcomes than staying in cash. Past performance never guarantees future results, of course, but the underlying principle that time in the market tends to matter more than timing the market has shown up consistently across decades of data. Let's make this concrete with 2 people, Felix and Maya. Both of them start investing at age 25. Both have $200 a month to invest. Felix is a natural researcher. He reads earnings reports, tracks macroeconomic signals, and waits for what feels like the right entry point each time. Some months he invests, some months he holds cash because something feels off. On average, he ends up sitting out about 4 months each year. Maya doesn't do any of that. Every month, same day, she transfers her $200 into a low-cost index fund. She doesn't check what the market did that week. She doesn't wait for dips or avoid peaks. She just invests and moves on with her day. By age 55, 30 years later, who comes out ahead? If we assume a modest average annual return in line with historical long-term market averages, Maya would come out significantly ahead of Felix. Not because she made better decisions, but because her money spent more time in the market. Felix's habit of sitting out 4 months a year doesn't sound like much, but across 30 years, that's roughly 10 full years of contributions that never made it in. 10 years of compounding missed. The irony is that Felix probably feels like the more thoughtful investor. He's analyzing more. He's being more careful. But in practice, his caution is costing him more than any bad timing ever would have. So, what does all of this actually mean for you? First, if you've been waiting for the right moment to start investing, this study is a fairly direct message that the right moment is almost certainly now, not later. The cost of waiting, even waiting for genuinely better conditions, tends to outweigh the benefit of a slightly better entry price. Second, if you're already investing, the data suggests your energy is better spent on consistency than on optimization. Monthly contributions, automatic transfers, boring discipline. These things matter more over the long run than finding the perfect moment. And third, the part that doesn't show up in the numbers but matters just as much. Notice that the investor who did the worst in this study wasn't Rosie, the one with terrible timing. It was Larry, the one who never acted at all. The biggest risk in investing isn't making a move at the wrong time. It's never making a move. The truth is, the Schwab study isn't really about timing. It's about behavior. And the behavior that wins, consistently, across decades of data, is also the least exciting one. Put money in, keep putting money in, and let time do what time does. The market doesn't reward people who wait for perfect conditions. It rewards people who show up consistently for a long time. If you found this helpful, please like and subscribe to keep growing the Slowfolio community. Thanks for watching and see you very soon. Bye.